In this webinar, we're going to look specifically at how you finance your first commercial property purchase. And we're going to look at the difference between an owner-occupied commercial property purchase and an investment one. So when we talk owner-occupied, what we're talking about is a business owner who wants to operate a business from the commercial premises, as opposed to an investor who wants to buy a commercial property that it's going to have a tenant there, it's going to be paying their rent. So we'll get into it. We're also going to look at those two differences, and we're going to look at how commercial finance differs from residential finance. So the first difference is the deposit. The deposit required if you're an investor in to buy a commercial property is generally 30 to 40%, whereas opposed to if you're a business looking to buy a commercial property for your business to operate out of, the deposit can be as little as 10 to 20%. And that'll depend on the strength of your business as to where that falls. In comparison, with residential property, you can get away with as little as 5% deposit. Now, a lot of investors will come to us or people looking to buy commercial property and say, look, I just don't have that cash in the bank for the deposit, but we do have equity in residential property. And in that case, what one can do is look at this example of a residential property valued at $1 million. Banks will let you access equity up to 80%. So that would be up to a ceiling of 800,000. If the current home loan is 400,000, there's a further 400,000 that's available to be drawn out and placed as a deposit on a commercial property. And we can see here in this case, the investors found a property for 900,000. The stamp duty and costs need to be covered, 40,000. So the total requires 940,000. If it's commercial property investment, bank will likely lend eventually up to 60%, being 540. So the difference required can come from the equity in the existing residential property. That's usually done as a home loan, but obviously you'll need to meet repayments on that amount there and this amount here. So you are effectively borrowing the full amount. You've just split it across two different properties, one residential and one commercial. When it comes to your borrowing power for commercial property, again, the big distinguishing factor is it for investment or is it for your business to operate from? If it's for investment, the key bit of information you want is the information memorandum. So all agents will usually have this on file and be able to give it to you. It's often referred to as just as the IM, and it's something the bank will want to initially assess your ability to be able to purchase the property and obtain finance for it. And that IM is going to provide details about the current tenant, which is going to be really important to the lender, about the current lease in place. Are there any increases each year? The term remaining, very, very important. And the property's ability to cover the loan repayments based on the rent coming in. So, and then we'll look at, if there's space there that's not currently rented, is there room for other tenants to be brought in? But if you don't have another tenant in place, it's unlikely they're going to rely on potential income in the future. They want to see tenants that are in place already with a signed lease. The quality of the tenant is really important. So you can imagine an ASX listed company gives the bank a lot of comfort that they're going to be there for the long term with their lease, and they're not going to run into financial difficulties where they have trouble meeting their repayments, meeting their lease or rent payments. So that's really, the tenant is very, very important when it comes to investment. When it's owner occupied, you are the tenant really. So your company and your company financials are going to become the big thing. And they're going to want to look at the rent that you're going to be paying. Usually your other entity, there's usually you'll operate your company in one entity and purchase a property in another. The zoning details and the details of the property, and I want to see a copy of that lease between the purchasing entity, which quite often is an SMSF, not always, but it's a pretty common structure to do that. So the lease between the lessor and the lessee being your operating business. The loan terms, this is a big difference between residential lending and commercial. Residential lending, typically, it's over a 30-year term. With property investment for commercial, it's generally over the length of the lease. So if you've got a tenant who's leased a property for 4 years, that's the length of the lease typically. Now, when we talk about the lease in that instance, that's when the bank will, the loan term, that's when the bank will usually want to review the finance facility again at the end of that 4-year term, matching the lease. But it's not when they expect the debt to be paid off. It wouldn't be realistic. So the borrower may opt to take interest only during that period, still reduce the debt if they want, but interest only repayments, or they may want principal interest repayments, but over a 15-year term, so a bit more like a mortgage, which is pretty common. And this diagram sort of shows how that might work. So keep in mind that when that lease expires or is coming to the end of expiry, it's really important to have measures in place as to how that income is going to continue, because the lender is going to want to review the current circumstances, may want another valuation, and they're going to want to know, is that tenant signing up for another 4 or 5 years? Do you have another tenant coming in, or is it going to be vacant? In which case, how are you going to make the payments? Interest rates. So typically with residential lending, interest rates are set by the banks themselves and based largely off the RBA, what the RBA is doing, but they can fluctuate by themselves. With commercial property investment and commercial lending, it's based off the bank bill swap rate, the BBSY plus a margin. So the bank bill swap rate, which is the interlending interest rate between banks, may sit at about 3.5%, and they may put a margin on that of about 3% to give you an interest rate of 6.5%, which is usually variable. As a rule of thumb, you might want to consider that commercial lending rates are about 0.5% higher than residential. The upfront costs are really important as well, and particularly, you may be charged an application fee with a commercial property loan, and you'll usually have to cover the valuation. The valuation costs can be a lot more significant than residential. For $1 million property, it might be $1,500 to $2,000. But you can imagine if it's a $10 million property, it can be in excess of well over $5,000 for the valuation. And that's something that the borrower usually has to pay. The key risks with commercial property, therefore, are the tenant themselves. So if that tenant doesn't have a lot of time remaining on their lease, or they're not particularly financially strong, what's the big risk that the owner carries? And if that property is vacant, it can remain vacant for an extended period of time. Often that risk is much larger than it is with residential property, which is why the lenders want a bigger deposit to build in a bit of a buffer for themselves. So the owner-occupier versus investor when it comes to commercial property, really the commercial investor, you're relying on the tenant, whereas the owner-occupier is relied on the borrower themselves. And their trading business, lower deposit on the owner-occupier, higher deposit on the commercial investor. And usually, I guess, lenders probably see that owner-occupiers are going to fight hard to make repayments as opposed to investors. So the key takeaways being that commercial property generally requires a larger deposit. There's significant assessment on the tenant themselves. The loan terms are often aligned with the lease, so keep in mind, and there's regular reviews, which don't really exist in residential lending. But there's more costs upfront. There's greater risk with tenancy vacancies, and there's more favourable terms on the owner-occupied space. So just if we coming down, I'll just try and give a few examples of some information memorandums, just so, because these are a great place to start, something you can usually ask the agents for. So this one you can see here is property. This is quite old, but most of them will come with some sort of executive summary, a bit of detail around the size. The part that I usually try to go to pretty quickly is the tenancy schedule, which is here. So, sorry, that will come back. You can see that there's one tenancy within the building that's vacant, the size of it. And then there's another tenancy here and another tenancy here. And that makes up your rent. You can see the lease term remaining. So obviously the longer the lease remaining, the better. And importantly, any rent reviews that are built in. So if there's a 5% review built in, usually that's annually, so that you can expect that rental income, that lease income to increase by 5% each year, whereas this one doesn't have that built in. So lots of other really important information in the IM of which to go through around planning and zoning. But it's just a great start if you're just looking at property and want to familiarise yourself with it. This is one where the seller was actually providing a 3-year rental guarantee for the vacancy. So if we come down, you can see the net income, and you can see for here was the lease back. So this is um, more than likely the unit JK was the tenancy that was vacant, and the seller was prepared to pay um, ongoing rent of this to entice a purchaser in. This is the other tenant, which has a lease remaining for original lease term 5 years. Lease expiry is there, increases, and the net rent. This is important. So this here is giving you the rent per square meterage, which is really important and really helpful to compare against other properties. This particular property, you'll see, had some signage, which the vendor or the owner was receiving income for. What would be interesting to know is there any lock-in contracts with those companies that have signage there? And then finally, another one, so you can see commercial property here has multiple tenants. So lots of details about the property, the zoning, the area, all of which you can get advice on. But coming down to the tenancy schedule is where we can start and see 5 different tenants. The size varies, so consequently does the income and the term. And what the bank or the lender is going to calculate is the WALE, the weighted average lease expiry. And what they're trying to understand is what's the average lease term in proportion to the amount of rent being paid by each tenant. So this tenant here is going to have a bigger contribution on that WALE, that weighted average lease expiry, being that they're paying $52,000 a year, than the smaller tenancy would of 2 years. So it might fall at 3.5 years or something of that nature. But yeah, obviously QML, national company, so that's a good thing that they're in there. You just want to see the sort of financial stability of these other businesses and where they sit. But that is our webinar today on commercial property investment. I know it was short and sweet, to the point, but just wanted to give you an overview of how it differs to residential and some of the differences between owner-occupier and investor. But if you want to start having a look at different property investments, jump on Real Commercial, which is the realestate.com version for commercial property. Have a look, request some some information memorandums, have a look through them, look at the lease term, look who the tenants are, look if they've got options to renew, do they have reviews, and you can quite easily calculate the net rent income versus the purchase price to get the yield, and try and assess different properties that way. But the more you look at, the better. Please reach out if you'd like an indication of what your borrowing options are, be it commercial or residential. Thank you.